We are 10 minutes away from the most important federal funds meeting of the year. Jerome Powell is scheduled to speak at 2 o'clock p.m. Eastern, and it is a foregone conclusion that he will be cutting interest rates at this meeting for the first time in 2025. The big question is, how much are we going to cut? 25 basis points or 50. Maybe he gets aggressive and we see 75. If that happens, stock market's going to the stratosphere. But let's break this down before the report comes out, and I'll let you know what's going on. So the Federal Reserve, their job is to set the interbank lending rate, and that interest rate is what mortgages and car loans and everything else is based off of. And that rate is set to drive a dual mandate. The Fed has two jobs. Number one, and the most obvious, is to control inflation. When prices start rising too fast, inflation's getting out of control, what the Federal Reserve will do, and what they did in 2022, is raise interest rates to squelch that inflation. And so when it costs you more in interest to buy a house or buy a car or expand your business or anything else, you're less prone to do so. That cools the economy and prices slow down their ascent. But they have a second job, and that is to ensure a healthy labor market. Now, if job growth slows, they will cut interest rates to stimulate the economy and the jobs market. And that's the situation we're in now. We've all been waiting for inflation to come down to that Fed's 2% target, signaling it's under control for them to cut rates. But before they got the chance to do that, this happened. Last week's jobs revision showed that 911,000 fewer jobs than initially we thought were created were not. In other words, the numbers that the economy's been operating on, all the 2024 jobs, that number was overstated by nearly 1 million jobs. And so in the view of the Fed, 911,000 jobs have vanished overnight. And that lets them know, hey, labor market's actually pretty weak. The economy is in much worse condition than you thought. And so now their hand is forced. They have to cut interest rates to stimulate the economy and the job market, despite inflation still being at about 3.1%. It's a little higher than they want, but they're kind of caught between a rock and a hard place here. And adding to that pressure is, of course, the commander-in-chief, President Donald J. Trump, who has been adamant in his demand for Jerome Powell to cut interest rates yesterday. The Secretary of the Treasury, Bissett, has come out and said that rates should be 1.5% lower, 150 basis points. That'd be the biggest cut in the history of the Federal Reserve. And so all eyes are watching the market right now. And in about 6 minutes, we are going to see what that decision is, and it will have big ramifications for the stock market. So here's what we are expecting. The market, for the most part, is priced in a 25 basis point cut, but there are some investors who think it's going to get cut a little more. If he does not cut rates, and there's like a 0.001% chance of playing out, if he does not cut rates, look out. Stocks are going to fall, at least in the near term. The stock market is priced in. In other words, they have been told to expect between 5 to 8 interest rate cuts between now and the end of 2026. So the only question to them is, when are those coming? Now, we were also promised these cuts in 24. They didn't come. We were promised these in early 2025. They didn't come. So investors in the market are running out of patience here. If they do not see cuts and meaningful ones soon, they are going to abandon ship and hop out of the stock market, and you're going to see a pretty nasty market. But if we get 50, 0.5% or higher, and especially if he insinuates that there will be more cuts in 2025, aggressive into 2026. Of course, his term runs out in May, so he'll have no control over this past mid-2026. But if he sparks hope that more rate cuts are coming, that will be even better for stocks. And of course, those that are most affected by interest rates will probably do better. You're going to see movement in like home building companies, building materials stocks. If rates get cut substantially, that means lower mortgage rates. That means the housing boom we've been waiting for. It means all those stocks go up. You're also going to see a move towards risk-on stocks. And all that means is the more growth, riskier names, often these are like pre-revenue, pre-growth stocks. So like NuScale Power, SMR, OKLO, two good nuclear stocks, QUBT, and the other quantum computing stocks. These are just riskier stocks. Like most of them have no sales, no profits. They're being driven up on momentum based on expectations of the future, based on the fact that we're expecting these companies to go borrow billions and billions of dollars to do these massive expansions, deploy this quantum computing, these nuclear power centers, these giant AI centers, etc. So that's why those are all risk assets. So if we get a big rate cut, you're going to see all those big names fly. Sure, Walmart's going to do fine, Target's going to do fine, Johnson & Johnson, the boring dividend blue chippers, but the more volatile growth names are going to be making the bigger moves there. Now, the last thing I want to show you before Jerome Powell comes out here is that the data is unequivocally on our side for higher stock prices over the next 12 months. This is a chart showing every time that the Federal Reserve has cut interest rates while the stock market was at all-time highs. And that's the position we're in now. It is a fairly rare position because typically they cut rates to stimulate the economy when jobs are bad, when the economy is weak. And in those situations, the stock market is usually way down. And so to cut rates with the market already at highs is a rare thing. And when it has happened, 100% of the time, in 20 out of 20 cases, the stock market has been higher 1 year later. It has been higher on average by 13.9%. So while anything can happen, history says we go up from here. The stage is set for higher prices. What we have is a stock market sitting at all-time highs. We have inflation, and this is a chart of CPI, the Consumer Price Index, core CPI, at about 3.1%. That's higher than expected, but inflation doesn't just drive up the price of houses and cars and eggs, it also drives up the price of stocks. We have expected rate cuts, which again stimulate stock prices to go higher. We have GDP growth at 3%. That is a healthy environment that tends to drive stock prices higher. So if stocks do not rise over the next 12 months in this environment, it would be the first time anything like this has ever happened. So in my mind, the question is, are we going to go up a little or are we going to go up a lot? So let's tune in to Jerome Powell and see what the decision is. Okay, news is out. Stocks are rising. Let's see what we got here. Hold on. Fed rate. All right, so we got bonds on the right, stocks on the left. Stocks surging here, currently up about 0.25%. Really not that big of a move. Interest rates have fallen a little bit as well, pretty much in line with expectations. This move looks a little bit more exaggerated than it is since I'm in a 1-minute chart here. I'm trying to pull up the data. It'll take a second for Google to update us here. I'm sure it looks like it was a 0.25% cut. Yep, 4.25 versus 4.5. So he cut rates 0.25%. Okay, this is on the lower side of expectations. This is going to be a little bit rocky. Let's see if I can get that news conference back up here. Okay, they're just tooting their own horn here about what they do and making themselves feel important. All right, Router give us a live update. Let's see what we got here. Here's their statement. Let's see. Growth of opportunity moderated in the first half. Yep, job gains have slowed. That's what we were talking about. The employment rate has edged up. Exactly. Seeks to achieve maximum employment. Inflation rate of 2%. Uncertainty both in economic conditions remain elevated. That means you got to cut. Committee's attended to the risks in support of its goal in line of the exchange. Committee decided to lower the target rate for the federal funds by 1/4 percentage point to 4 to 4.25. Okay, so the market was right. 25 basis point cut, 1/4%. So far, the market likes it. I guess there was a little bit of doubt there. Trump and Powell, there is no love lost between these two guys. There were some suspicions that Powell would try not to cut rates just to spite Trump, just to tick off the guy who's been calling him out. But it does appear that they did. So 1/4 basis point cut. I was hoping for 50. The market was hoping for 50. If we step back here to a daily chart, you can see it's not really a big move. What we had here, we got a bit of a gap up yesterday, but is holding pretty much in that same range. So, but nonetheless, a positive reaction. Really, really quiet. S&P 500 index from the meeting, currently up about 0.4%, so not huge. Over here on the right, that's the 10-year bond yields. That went from 4.05 to 4.00. We can take a look at like the 30-year yield. That'll give you a better idea, down from 4.65 to 4.63. So this looks dramatic in a chart, but it's really not. Like if you go here, that the move is like this little thing right over there, right? And this is what happens. Markets, I tell people all the time, the market, whether the bond market or the stock market, it is a discounting mechanism. It is constantly pricing in all known information. And if you look here, once that jobs revision came out, let me see if I can find the screenshot of it in here. Once they reported, once we saw this and they revised job growth down by 911,000, everybody knew what was coming. Everyone knows the Fed has to act, and that came out right here. That's when interest rates came down, so it went ahead and priced this in. The 30-year bond yield fell from basically 4.95 to 4.65 on this news. So that's them pricing in that cut, and that's why we're not really seeing a dramatic reaction in the bond market. I mean, this looks dramatic, but really it's not. It's from 4.65 to 4.62. I mean, it's a rounding error at best, and that's because all this is priced in. So the market essentially got what it wanted. It got what it expected. So here we go. We are cruising in to the final quarter of 2025. And just to summarize, and I want to wait and see what Powell says in this meeting. Everyone's going to hang on his every word there. But if he talks to the effect that they are expecting more cuts going forward, if he reflects that they will likely cut at the November meeting or that they could cut by 50 basis points next time, or speaks to a lot of cuts in 2026, that's going to add fuel to the market. But we have strong GDP growth, we got hot inflation, we got interest rates coming down, the stage is set, stocks are soaring higher. I hope you take advantage of it.